Thanks for clicking. With the Canadian economy growing at 6.7%, our inflation rate at 5.1%, and the Bank of Canada raising interest rates for the first time since 2018, Bank of Canada Governor Tiff Macklem offered an economic update for the Canadian economy on Thursday. With Canada's inflation rate showing no signs of slowing, especially with the Russian invasion of Ukraine, Bank of Canada Governor Tiff Macklem offered the Bank of Canada's view on Canada's persistent inflation.
The inflation story in Canada has three key elements.
So what I want to do today is go over Tiff Macklem's story of inflation.
That's a good story.
As the governor offered three main reasons for our rising inflation rate. Then I want to go over what to look for in the future, as I think there were some key tidbits within the speech that will give us good clues as to what to expect next. Speaking of the future, we'll continue to have updates on the Canadian economy as we're expecting the release of Canada's February inflation rate in a couple of weeks, as well as the release of the Federal Reserve's interest rate policy very soon, both of which will probably have a direct effect on our own interest rate policy in the months and years ahead. Click like and subscribe if you want to get those updates, but for now, let's get into Tiff Macklem's speech. As mentioned, Tiff Macklem stated that there are three main reasons for the current state of Canadian inflation, with the first being a global shift towards goods rather than services.
The first is the global shift towards goods and away from services during the pandemic, combined with pandemic-related disruptions to the production and delivery of goods.
As demand for goods goes up without a corresponding increase in supply, the price of goods will go up. And this chart seems to bear that out. While pre-pandemic we saw the inflation for services constantly outpacing inflation for goods, these two flipped in 2021, with goods inflation far outpacing services. So as consumers were unable to buy any of the traditional goods the traditional services that they are accustomed to, they shifted their demand towards goods. And since there was no corresponding increase in the supply of those goods, prices went up. The governor also indicated that throughout the pandemic, we obviously had supply chain issues, which also do seem to be receding, slowly but surely. Though they are receding, the governor said that this should get better and better in time as the pandemic continues to recede.
As the pandemic recedes, we can expect consumers to shift back to spending more on services, and this should take some pressure off the demand for goods.
Yes, we've heard that before. We heard that right before Omicron, but all things being equal, the supply chains and the demand for goods should start to normalize as the pandemic goes away. Again, hopefully. Though the governor did mention that the growing war in Ukraine with the Russian invasion could definitely complicate things and could further exacerbate supply chains.
And the war in Ukraine is compounding this difficulty, as it could also disrupt global supply chains.
So, we do have, under the first story of inflation, we have a growing demand of goods without a corresponding increase in supply.
Supply and command.
But this is supposedly receding, and that part of the inflation story should get better as time goes on. So while that part of the inflation story is receding, the second part, not so much, and that is the broad increase in the price of everyday goods. Anyone who's been to the grocery store or been to purchase gas
money bags
has seen that the price of everyday goods, the things Canadians consume every day that we need, that we can't really cut down on as much, has been increasing substantially.
Grocery prices are up 6.5% from last year, and everyday foods that are hard to substitute, such as beef, chicken, and cereal, are all getting more expensive. This broadening in price pressures is a big concern. It is making it more difficult for Canadians to avoid inflation, no matter how patient or prudent they are as shoppers.
Well, these everyday increases are definitely of a concern. A bigger, more pressing concern on the Bank of Canada's mind is that inflation will get ingrained in the psyche of Canadians. In that, if you think that the TV you want to buy next year is going to be far more expensive, you're going to buy it this year. If everybody does that, it increases the demand for that TV, which will drive up the price of that TV, which is a self-fulfilling prophecy. So inflationary fears get ingrained, people try to get ahead of inflation, and then as a result, it just creates more inflation. And this is one of the biggest concerns on the part of the Bank of Canada going forward.
The lesson from history is that if inflation expectations become unmoored, it becomes much more costly to get inflation back to target.
Finally, the third element of Canadian inflation, according to Tiff Macklem, is supply and demand. The Bank of Canada governor said that current price increases, the current increases that we're seeing at the grocery store, that we're seeing at the pumps, is not a result of increased demand.
With the economy just back to its potential output, the elevated inflation we are experiencing today is not the result of too much demand in the economy.
And then he went on to essentially say we need to keep it that way, raising interest rates in order to keep that demand side low while everything else does increase.
We need higher interest rates to dampen spending growth so that demand does not run significantly ahead of supply.
Essentially, what the Bank of Canada governor is saying is that we can't control supply disruptions. We can't control the price of oil. What we can control is demand, and we're going to do so through interest rate hikes. And that's what the Bank of Canada started on Wednesday when it raised our interest rates by 25 basis points. So, looking at this entire speech as a whole, I think what the Bank of Canada governor is saying is that there's only so much we can control, and we're going to control the things that we can. With higher prices coming basically due to inputs, stemming in large part from higher oil prices, the Bank of Canada is going to control what they can, and like we said, that is demand.
But raising the policy rate will not fix supply chain disruptions, nor will it lower oil prices. What monetary policy can do is make borrowing more expensive, which slows domestic demand.
So they are going to make it more expensive to borrow, and they are going to incentivize saving by raising interest rates. And I think what he's saying through this speech, in that he mentioned Ukraine at least 6 times, is that we can expect to see higher oil prices and higher inflation as time goes on, which we can't really control that. And what we can control is our demand, is how much Canadians can spend in the economy. So I think what he's really saying is that higher inflation is coming, and that we can expect them to continue to raise interest rates to combat that inflation. Throughout the past few years, we have seen higher inflation, but that was really explained away in large part due to the pandemic, due to increase in demands for goods and disruptions in supply, as Tiff Macklem mentioned at the beginning of his speech. And they kept interest rates low. But now that's really not the case. What they're doing now is they're saying that the inflation is caused in large part from supply disruptions, but also from an increase in the price of oil and disruptions that we're obviously going to see as this war in the Ukraine continues on, and nobody can really predict how long this is going to go and how bad this is going to go, which is definitely not great going into the future. It's definitely an uncertain time, but this speech does seem to indicate that the Bank of Canada does plan on continuing to raise interest rates and doing what we can to slow down the inflation on our side. It looks like they're not going to let inflation run hot. They are returning to that 2% inflation rate, and as much as they can.
The bank is committed to returning inflation to the 2% target and keeping inflation expectations well anchored.
I think that we're in for some more interest rate hikes coming down the pipe soon, and that will obviously be dictated by the pace of our inflation rate, which we will have updates out on this channel. And if you want to get those updates, click like and subscribe, and thanks so much for watching.